way, we are starting now and microphone is working, so please keep quiet. So as usually, we will start by repeating some important things from the last class. So we said when you buy a company, you own part of a company. When you buy a stock, a share of a company, you buy a piece of a company. And you do that because you expect to get some part of the profits. And how it looks. So, in year 0, you buy a share for price P0. Let's say Microsoft stock is trading for, I don't know, $300. So you can buy one share of Microsoft. This gives you ownership in, I don't know, 1/1,000,000th part of a Microsoft. I don't know how many stocks Microsoft has today, but this is the idea. So when you buy one small part of a Microsoft, you expect some profit. And usually corporations will give you some dividends over time. So if you own this share, for each share you own, they will give you one dividend. And then in year P1, in year 1, you can sell this company for a price P1. This stock, this share, is now worth P1. When you sell it, that means that you have made a profit of P1 minus P0, which is the difference in price. So let's say price was 100 per share. Now in year 1 it's 120. You have made $20 since you bought something for 100 and you are able to sell it for 120. But also company gave you dividends. Let's say you received $1 from this company. That means that your profit in this example would be $21. But you have paid for it $100. That means that you have realized the return of, I don't know, 21 over 100, 21%. Okay? And this is why you are holding a company stock. Now the question is, how do we calculate what is the fair price today? We said, well, what price should you pay for a company? You should pay the price that is equal to the discounted cash flow of all the future cash flows that you will get from this company, of the cash flow stream that you will get from this company. So if you hold company for age periods, you will receive dividends, and in the final period you will be able to sell it for PH and you will get the last dividend. And every payment you discount with the corresponding discount factor. Then we said, okay, our horizon can be 3 years, it can be 4 years, or it can be 50 years. And we said, as we prolong this horizon, I gave you an example. And let's say that in this case, with 50 years horizon, return discount rate is 10%, then the discount factor for the cash flow that appears at period 50 is 0.008, which means if let's say that the price at which you are selling a company is $100, that means that it adds to total present value of company just 8 cents. So what this is kind of an indication, we can kind of, if we hold company for a long period of time, what matters are kind of dividends. And then this looks like valuing bonds in a sense. You have dividends and at the end you have a sales price plus the last dividend. Just in case of the bonds you would have coupons, and in the last period you would have face value plus the last coupon. But unlike with bonds this cash flow stream is completely predictable. What you get, these coupons that you get in case of bonds, they are written on the contract. It's said you will receive $50 each 6 months, and in the last month you will get $1,050. When you buy a share, when you buy stocks, nobody tells you how much you will get. Nobody knows what will be the dividends, or even less, for how much you will be able to sell this share after 50 years. This is not written in a contract. This is risky. So we said, okay, but let's pretend that we will keep this company forever. And we know how to deal with things with cash flows that go perpetuously. So if the cash flow is constant, then this is a perpetuity, and we know that the perpetuity is valued as cash flow divided by R. This is C over R, and in this case this would be dividend divided by R. But we said this is not really a good approximation for corporations, because corporations usually grow over time. They grow over time. It's not that they are all the times the same. So we said better approximation of a company is a constant growth perpetuity. When applied to valuing stocks, this is what is called Gordon growth model. And we said if dividends are getting larger and larger over time at the constant rate G, then, and the first dividend is paid in one period from now, then the price of this stock can be calculated as dividend 1 over R minus G. Now, we said this is a really great thing because this is a really simple formula and very simple approximation. However, it has some flaws, and these are the problems. We said, first, in reality, companies do not grow at a constant rate. In reality, we know that there are these business cycles. There are periods of high growth and periods of low growth. There are even periods of recessions. So we have booms and recessions, and they are kind of cyclical. We observe business cycles. Business cycle is a very well-studied phenomenon. Another problematic thing is, I mean, what do you do if your company is not paying dividends? How do you estimate what is going to be a dividend in a year from now? It's a difficult problem. Additional problem is that this price is very sensitive if R is close to G. Estimate of a price is very sensitive if R is close to G, because R minus G is then close to 0. And when you divide a number close to, with something close to 0, then this is a large number. And then the mistake will be large if you wrongly estimate dividends, or if you have a mistake in any of these parameters, you will see how large mistakes can be. We did the example with the Twitter, and we've seen that just by small mistakes you can get from 10 billion to 100 million easily. We just made 2 small mistakes. Now the question is, how do you get this G? How do you get this growth rate? And I gave you an example which I believe well explains the idea, the basic idea. Imagine that you have a company that has earnings of $8.33 per share. So these are earnings per share. It can pay to every shareholder, so if you own one stock, one share, you will get $8.33. And these are all earnings of the company. So total earnings would be number of shares times earnings per share. So the question is, what is the value of this stock? Well, the value of this stock, if the company is not investing anything, if it pays out everything to dividends, it is fair to assume that this company will not grow. It cannot grow out of anything. If you give all your profits next year, the only thing that you will be able to do is to do the same thing as you did last year, not more than that. So this company will not grow. So this company is going to be, you can assume that this company behaves like a perpetuity. You have constant payments over time, every period of time, each amount. So in this case, when there is no growth, it would be C over R, and C in this case is 8.33 divided by R, which is something similarly risky, is $55.56. But now we said company can try a different strategy. Let's invest part of these earnings into operations of this company. And let's say that company, for each dollar that it invests into its operations, gets 25% on top of it, gets a return of 25%. This is return on equity in this case. 25% company gets for every dollar that it invests in its operations. So let's say that the company decides to invest 40% of earnings into operation. That means that this company will grow at a rate of 10%. Try to think about this equation in the following way. So 40% of what you have will grow at the rate of 25%. 60% is something that you spend. You give it to your shareholders, so this will not grow. So if 40% of everything that you have grows at the rate of 25%, how much everything altogether grows? Well, it grows at the rate of 10%. So next period of time, you will have actually 10% more over what you have had in the previous period. And then let's assume that company does that every period of time. So every year, 40% of their earnings is reinvested at the rate, at this return on equity rate. So every period of time, they reinvest 40% of earnings into their operations. But every period of time, they have more and more in absolute terms. So our dividends will grow at the rate of 10%. This is this growth rate. You understand this equation? It's pretty intuitive, you know. You do not reinvest everything. If you reinvest everything, you will grow at the rate of 40%. If you will grow at the rate of 25%, because you invest and you have 25% more. But you do not reinvest everything. You invest only 40%. So this 40% will grow at the rate of 25%. But out of the total value that you have, this is just 10% more. So if the dividends grow over time at the rate of 10%, if the dividends grow at the rate of 10% over time, what is this? Then this is a constant growth perpetuity. How do we calculate the value of the constant growth perpetuities? C1 over R minus G. C1, I say this is 5. R, we know it. G, we have just calculated. Now, why is C1 5 and not 8.33? Well, this 5 actually comes from the fact that out of these $8.33, you choose to reinvest 40 cents. So to your shareholder, you will pay actually 1 minus 0.4. You will pay out 60%. And this is how we get to the 5. Yes, we will have less in a year from now, but we will grow. This will grow over time. So it's not necessarily worse that you have reinvested one part. So, ideally, if you want to calculate the value of some company, you would say, observe the cash flow stream of this company from tomorrow until eternity, and model these cash flows explicitly. But this is something that is very difficult and unrealistic. It's very difficult to estimate how much you will get from a company in 10 years from now. I mean, 10 years from now, there may be atomic war. I mean, nobody knows what's going to happen in 10 years from now. So what people usually do is you model first couple of years of life of a company, next couple of years, explicitly. You assume, okay, in year from now I will get this much, in 2 years from now I will get this much, but then later somewhere in the future in the company you assume, okay, this company will just become an average company in the industry that it belongs to. Not more than that. So, when firm grows at this constant rate forever, a year before this growth starts, this cash flow stream is worth C1 over R minus G. And now this constant growth rate is called a stable growth rate and cannot be higher than the growth rate of the economy in which firm operates. So it's not reasonable to assume that you will get better, because I mean, if you assume that your company will grow at the rate of 40% forever, then this company is probably worth infinite amount of money. There is no company that can match that. There is no equivalently risky thing that will grow forever at the rate of 40%. There's simply no company in the history of the world that was growing forever at the rate of 40%. These things don't exist. So you can assume that some companies can maintain high growth rates for long periods of time, but at some point they just converge to this stable and start looking like just a normal company in this industry. And then when they approach this stable growth, then you use the formula from above. Before that, you calculate cash flow stream explicitly or whatever, depending on how it looks like. Okay, so usually what you assume is that you have some high growth period and then company continues growing at some constant stable growth rate. Or you can assume for some company, if it's a really mature company, that it already is in this stable state. That's also okay assumption. For some companies, you will assume it grows like crazy, and then it converges to just a normal stable growth. Or you can assume that it grows, and then this growth is steadily decreasing until it reaches stable growth, and then you use the constant growth perpetuity formula. So how to choose among these assumptions, or even create some additional assumption? Well, this depends from case to case. It's difficult to say. Some companies, large companies, usually do not grow really fast. They don't have these high growth periods. Usually they grow really fast when they are small. It depends on the size. It also depends on the current growth rate. So if higher, the longer the high growth period. It also depends on your competition. How easy is for your competitors to enter the market. If it's really easy, they will enter the market, put down your margin profits, and you will slow down your growth. So, usually what we do, we model cash flows for the first couple of years explicitly, and then later we assume that there is some terminal or horizon value which comes from the fact that you assume that this company will continue growing forever. And this is what we did in our example. We had some cash flow stream, and we said, first couple of years, we model this cash flow stream just year by year. We make explicit assumptions what we will get from year to year. And then in year 7, we say this company from year 7 on grows at a rate of 6%, and every year it gives 6% more. So what's the value of this company? We first calculate present value of this cash flow stream. This is easy, you just discount each cash flow with the corresponding discount factor. Then, if you observe this cash flow stream, the first payment takes place in year 7. So, from the perspective of year 6, this looks just like a normal constant growth perpetuity. So from year 6, we can use, from the perspective of year 6, we can use the constant growth perpetuity formula. Or in other words, this cash flow on top, this constant growth perpetuity, will have exactly the same present value as the cash flow stream that gives you amount of C1 over R minus G in year 6. So how much is the cash flow stream that in year 6 gives you C1 over R minus G? And what is C1? C1 is 159, R is 10%, G is 6%. So how much is that worth in year 0? Well, we have to discount it for 6 more years. And now we calculate the present value of this thing, and this will be our terminal value. So we add this horizon to terminal value, present value of it, and the present value of free cash flows, and we get the value of the company. We said also that if we observe this equation, if we assume that company is perpetuity, if it pays constant dividends over time, meaning if there is no growth, then value of a stock can be calculated as dividend over R. Actually, index 1 here is not needed because this assumes that dividends over time are constant. So dividend 1 is equal to dividend 2 is equal to dividend 3. If this holds, that means that this company is not investing anything into its growth. So there is no investment in growth. So basically dividends are the same things as earnings per share. And you know, this is a number. This number you can read in annual report of every company. They are required to state this in their annual reports by law. So this gives us the rationale for other method of valuing companies, which means select companies that work in the same field as your company does, whose price you know. So you check the price, check publicly traded companies who have price in the stock exchange. You know what's the price at which it's trading. that do the similar work to what you do. And among those, select firms that have similar earning per share as your company does. Then your price should be similar to them. This is a rough approximation. This approximation assumes that there is no growth in order for the relation that I showed you before holds. So in that respect, this is an approximation. But if you cannot do better, this is a decent approximation. Some people will not use earnings per share, but some other ratios like, I don't know, like book to market value or something like that. But the point is, this has theoretical founding. I mean, there is a reason why earnings per share should matter. And you know, earnings per share differ by industries. There is a different earning per share in mining industry and in software industry. So when you are comparing, you should select companies similar to yours, doing similar thing as you are doing. Okay, now we move to something different. Now we are basically finished with companies in this chapter, in valuing stocks. Now we are going to talk about the net present value again. I mean, if you have some questions, please ask, but please do not talk. I mean, you're disturbing me, and this recording will not be as clear as it should. So we are going to talk about the net present value and other decision tools that people use in their process of doing business. And I will talk about most of them to you now. So, first, why do we need a decision tool? Imagine you are a firm and you receive some cash. You have money. You can decide what to do with this money. You can invest it into operations of a firm, or you can pay it out and give it to the shareholders. Now the question is, what do you do? We said that every shareholder will like you to invest into things that increase his net present value. And why is it like this? Other rationale besides the one that I have given you before. Imagine you are a shareholder. You have an alternative. If firm is not doing their job, doesn't have good projects to invest, they can give you dividends, and then you can invest into financial markets. You can invest in other companies. You can invest in bonds. You can invest in a bank. So, in a sense, this is why you prefer getting increasing net present value, which tells you that the company is able to get more by investing in some projects in terms of percent than you can by investing in some alternatively risky things. Now, if you are in a position of chief financial officer who has to decide what to do with this money, you need some decision tool. You need some decision criteria that will tell you what to do. One of them is the net present value. And if you observe this survey, this is a survey of chief financial officer on which decision tools do they use in their work. And 75% of them use net present value. 76% of them uses internal rate of return. We will see what is that. Less use this payback time, 20% use book rate of return, and profitability index only 12%. And these are not invented numbers. I have not just drawn this chart. You have a reference. This is from some paper that actually called CFOs and asked them, okay, which tool do you use to decide whether to invest in A or B or pay out dividends? Now, why is this important? Try to interpret this chart in a bit different way. Don't think about what CFOs do. Think about it like this. What is the probability that my boss will ask me to calculate net present value? By looking at this picture, you can say 75%. This is a pretty high chance. What's the probability that I will need to know and work with internal rate of return? Also pretty high chance. So, what I'm trying to tell you here is that you should not take things for granted. You know, when some other professor tells you the thing that I'm teaching is so important, I mean, ask him, okay, show me the numbers. What's the chance that somebody will ask me that? If this is so important, then somebody probably has done a survey and published that in some scientific paper. I mean, this is what these papers are used for. They are not used just to, to fill the pages in some books. We should learn something from them. And this is what we learn from this paper, that these CFOs use these decision tools. Don't trust somebody, you will need this. Maybe you will, maybe you won't. I don't know. Okay, so we go to this book rate of return first. And as you can see, book rate of return is not really popular. It's around 20% of CFOs use it. So what is book rate of return? Book rate of return is a ratio of two numbers. Book income divided by book assets. So what's the point of this measure? Well, this measure is trying to capture somehow return. This tells you, if these were like income over assets, this would be what is the income compared as a percentage of the total value of assets. But the problem with this measure is, in real life, measuring total assets is really difficult. What's the value of total assets? You would have to know the market price of each share. But these objects have some book value, some accounting value. As you have learned probably in your accounting classes, when you buy something, its current value is what you have paid for it, its market price. But over time, you don't call and check what's the price of used shares. You somehow depreciate the value of the share. You say, it loses 10% per year, for example. Now the problem with these measures is that these two numbers are some almost random numbers. I mean, they are somehow related to the value of the company and to the income of the company, but they are not real things. Book income does not tell you how much more money you earn. It's some book, it's some accounting value, which is distorted by different things. Book assets, also, I mean, this is just some number. It doesn't mean that you can actually sell this chair for the 10% of its value after 1 year. It doesn't mean that. You have to account somehow this depreciation, and you choose some reasonable numbers to do that. But this is not the price that you can actually sell this chair for. And actually, I like to say, and this is the reason why only like 20% of people use this measure. This is the reason why it's not so popular, because it does not really capture rate of return. It captures something a bit illusionary. It's not predictable. And also, these numbers, it's very difficult to cheat on market price, because you can either sell it for that price or you cannot sell it at that price. But we have seen in many cases in history that books, that accounting values do not represent a fair value of a company. We had these big scandals like Enron Corporation. It was apparently worth billions, but it turned out that it's worth almost nothing. So, I like to say also that this chart actually can tell you what percentages of chief financial officers come from the accounting departments, have accounting background in a sense. Because, nobody who learned about finance will not use this measure. Why would you use some illusionary number as a measure of success? It simply doesn't make any sense. Only if you're an accountant and you really believe in these things, then you will use it. Accounting is important. I don't want to underestimate the value of accounting. If you do it wrongly, you are in a jail. So it's important. But then again, this measure is not good for deciding whether to invest in project A or project B. It's simply not. It's not a reliable measure. So the next measure that I'm going to talk about is a payback rule. And you can see the payback rule is used by 57% of managers, of CFOs. So there is a pretty high chance, pretty high probability that somebody will ask you about this measure. Now, this measure is far away from perfect, even though many people use it. And now let me try to explain what this measure is. So this measure tells you how much time is needed that you repay this project, how much time you need to get your investment back, but not taking into account present value of money. Just adding dollars in year 2 and 3 together and stuff like that. So this is not a perfect measure. And it has many flaws. But since your boss will very likely ask you about this measure, you have to understand this measure and understand what are the deficiencies of this measure. Because even if he asks you about this measure, he might ask you, okay, according to this measure, should I buy this or should I not buy this? The fact that the measure is bad doesn't mean that you are allowed to make bad conclusions out of it in your working environment. So to give you an example, how it works and what it is. Imagine you have the following 3 projects. You have project A, in which you need to invest $2,000 today. And you get 500, 500, and 5,000 over the next 3 years. This is project B, this is project C. Now let's observe project C first. What does a payback period of 2 years means? That means that after 2 years you will recover your initial investment. So your initial investment is 2,000, and now 1,800 plus 500, this is 2,300. So after 2 years you will have recovered your investment. But this is without taking into account present value of money. So this is in a sense a bit nonsense. In case of project 2, you will have again 2,300 after the second year, and payback time is 2 years. In project A, you will recover your investment only after 3 years, when you will have basically 6,000, and this is when you will recover your investment, because after year 2 you have only 1,000. Now, what's wrong about this? Well, many things are wrong. First, according to payback rule, you would accept the project that has the lowest payback rule. So one of these 2 projects. These 2 projects are better than this one. And it's obviously wrong. The project A has much more in terms of present value, offers you much more. Imagine that instead of 5,000, you had 100 million here. This project would still be worse than these 2 projects down. So it disregards all the payoffs that happen after this payback time. Moreover, this thing disregards the present value, and this is present value, time value of money. Imagine, look at the projects B and C. According to the payback rule, they are exactly the same, because up to year 2 you have 2,300, which means you have repaid your investment. However, if you take into account the present time value of money, you calculate the net present value, one will have the positive present value, while the other will not. So, if you ask me, this is complete nonsense, but 60% of people use it. Now the question is why they use it. Because sometimes you just want to have like a good feeling when do you get your money back from your investment. So your boss asks you, okay, when do I get my money back? And you tell him payback time is 2 years, which is wrong in a sense, but nevertheless, it's a quick, easily calculate. You don't need to calculate basically anything. You just need to quickly add numbers. And this can be very misleading to make any kind of decisions. Okay, now we are approaching internal rate of return. And the internal rate of return is very, very important. It is very, very likely that you will have to understand it and work with it, and this is why we are going to dedicate much more time than to previous measures, which are kind of less important. So, I will try to explain what is internal rate of return on an example. And let's look at this example. You have an investment of 4,000 that will generate 2,000 and 4,000 in next 2 years. So what does it mean? Today, you invest 4,000. In a year from now, you get 2,000. In 2 years from now, you get 4,000. Now, the internal rate of return is actually a rate that you use to discount your cash flow stream that will give you the net present value equal to 0. So this is the rate that if you use to discount your cash flow stream, will give you net present value equal to 0. So in this case, I'm telling you this is 28.08%. Now, if I plug in 28.08% in this equation, left-hand side will be equal to 0. Okay. But what is this rate telling us? What is this 28.8%? This tells us something similar as yield to maturity, and it should be kind of obvious that this is what the yield to maturity to bonds is. Internal rate of return is to projects. So if you have some cash flow stream like this, that means that if you invest 4,000 and you keep it invested into this project until the project's end, you will earn 28.808% on this project. So this tells you how much in percents do you earn over the life of the project. Okay? And this is the main reason why CFO love it. It tells them in percents how much they earn. I earn 10%. Wow, this is good. So project A earns 10%. Project B earns 15%. Which project do you prefer? Project B, which offers you 15%. However, the situation is far away from that simple. And now I will try to convince you what are the big dangers of the internal rate of return if not used properly.
Sir, can you explain one more time why you said the net present value equals to 0?
So, this is the price that you pay. This is your initial investment. Think about it as a bond. So, if you pay for a bond its current market price, yield to maturity will be what discounts this bond to its current market price. It's like here. If you invest $4,000 into this project today, this is the return that you will get from this investment. So if you invest 4,000 now and you exchange it for the cash flow that gives you 2,000 in a year from now and 4,000 in 2 years from now, that means that you have earned 28.08% on your investment. That's equivalent of earning 28.08% on your investment in a sense. I hope this is clear. So it tells you how much per year do you earn in percent. Now, the first problem with first disadvantage of internal rate of return compared to the net present value is difficult to calculate. How do you calculate? I mean, okay, we know how to solve quadratic equation, but we don't know if the cash flow stream has 10 elements, we don't know how to solve 10 order equation. So how do you calculate? Well, you can try. So for example, in this case, without using the quadratic equation formula solution, how do you calculate? You can say the following. Let's try what happens if I discount with 40%. Let's see. So if I discount this cash flow stream with the 40%, then the net present value is 530. If I discount this with 10%, the net present value is 1,123. So I know that actually the rate is somewhere in between. Let's try number in between 10% and 40%. What is it? It's 25%. So if we try 25%, we get to 160. So you see, we are getting closer to 0. Now we know that we are in between 25 and 40% because one has positive, one has negative. So let's take a number between 25 and 40. This is 32.5%. What's the net present value at the 35%? 32.5. It's 212 minus 212. Okay, now we know that we are in between 32.5 and 25. What's that? That's 28.75. So we get to the number of minus 33. And you see we are very close. We are very close to the solution just after 4 steps. The proper solution is 28.08 or something like that. And actually, I told you in your homework to use the formula internal rate of return to calculate yield to maturity. This is because it's basically the same thing, just yield to maturity is for bonds, what internal rate of return is for any cash flow. So internal yield to maturity is internal rate of return of a bond. This is the idea. It tells you how much percent bonds give you if you pay for its market price. And what's the relationship between equating net present value to 0? Because bonds, if you pay for them market price, the net present value of this investment is 0, because market price is exactly equal to the discounted cash flow stream of a bond. So the idea is that you find this spot on this chart. And actually, this is how Excel does it. Excel does not have some fancy formula to calculate internal rate of return to solve higher order equations. These formulas do not exist. Nobody in the world knows how to solve some high order equations. What Excel does, but you don't see it, is that actually it tries many of these values and it kind of converges like I did. It tries, it says, okay, this is positive, so let's move to this direction. Okay, this is too much, let's go back. And this is how Excel does it. You just don't see that when you enter IRR in your cell, or IKV in German version of Excel. Okay, but this is not the only problem. I mean, you know, this is a problem, but nevertheless we have an Excel or financial calculator, so we can calculate internal rate of return. But there are much more severe problems when it comes to internal rate of return. First, the rule is not that simple. It's not that simple you prefer the project with a higher internal rate of return. You have to think about it. This, what I will now show you, is a problem, but it's a problem. If you think about it, you can solve it. So imagine you have two projects. Project A, minus 1,000 plus 1,500. Project B, year 0, plus 1,000 minus 1,500. So what is Project A? Project A is you enter a bank and you tell them, here, I give you $1,000. And in a year from now, bank gives you 1,500. So this is like you have invested $1,000 in a bank, and after 1 year, you got 50% more. Project B is the opposite. You enter a bank, you ask them, could you give me $1,000 for 1 year? And they tell you, sure, no problem, but after 1 year, you have to give us 1,500. And you see, these both projects have exactly the same internal rate of return, 50%. They have exactly the same internal rate of return, 50%. And one actually has a positive net present value, and the other has negative net present value. Now, this is not a real deficiency of internal rate of return. It's just that applying the internal rate of return is not so simple as when it comes to net present value. With the net present value, it's simple. The higher the net present value, the better. The positive one is good, the negative one is bad. But with internal rate of return, so think about this. One is when you borrow money, one is when you lend money. So when you go to a bank to invest your money in a bank, you actually prefer higher rate. But when you want to take money from the bank, you want them to charge you the lowest interest rate later. So it's not so clear that it's always better to have higher internal rate of return. It depends. Is this borrowing or lending? And this situation can get tricky when you have multiple cash flow streams. Am I borrowing or am I lending? It can get tricky. But this is solvable problem. I mean, guys, you really can leave. I really don't mind if you leave. Problem number 2. As you know, quadratic equation has 2 solutions. Cubic equation has 3 solutions. More degrees you have, more solutions you have. Now, if you remember from your high school, sometimes solutions of the quadratic equations, some are real numbers like 1, 2, 3, some are complex numbers like 2 plus 3i. Have this imaginary square root of minus 1. But we don't care about this in this class. We care only about the real solutions. But sometimes it can be that you have multiple real solutions to this problem. and which one is the correct one. And actually, you can tell in advance how many solutions you will have. So if you observe a cash flow stream that looks like this, you invest 600, then you receive for 9 years 120, and then in year 10 you have to pay 150. This is just a normal cash flow stream. But, however, it will have two real solutions for internal rate of return. Two numbers will solve the equation of the internal rate of return. And actually it turns out, and this is a good rule to remember, that how many switches of sign in cash flows you have. For example, here you are switching from negative to positive, and here you are switching from positive to negative. That many real solutions you will have. So, to give you an example, I tell you, this cash flow stream will have two internal rate of returns. One is minus 44 and another is 11.16. So, this is the cash flow stream that I'm talking about. Just a normal cash flow stream, and there are two internal rates of return. If you plug 11.16, you will get that the left-hand side is equal to 0. If you plug in minus 44%, you will get that the present value of this cash flow stream is equal to 0. Both of them will solve it. So now your boss asks you, okay, can you calculate me internal rate of return? Which one do you tell him? It's totally non-trivial answer. And actually, this is a simple case. Just imagine if you have 10 switches on sign. That means you have 10 different solutions. Which one is the correct one? One should be really, really careful when using internal rate of return. With net present value, you have only one net present value for this cash flow stream. This cash flow stream has exactly one and no other net present value. While the internal rate of return has two. And you know, if your boss asks you, okay, what's the net present value? And you tell him, we should not do this. It has internal rate. If he asks you for the internal rate of return, sorry. What's the internal rate of return? Should I buy this? And you tell him, oh, this is minus 44%. And he does not do it, and it turns out that actually it's 11 is what happens. You get fired for this kind of things. You lose a job. I mean, this is a real life. Nobody cares whether you know or you don't know. And actually, if you use Excel, and you tell to Excel IRR of this cash flow stream, it will give you just one answer. Which one? Who knows? Nobody can tell. They don't tell you how they come to the solution. And actually, in the Excel, you can actually pass another parameter to the IRR function. You can tell him IRR of the cash flow stream, comma, and then give him a guess of the correct solution. You tell him, okay, start from this value when you are doing this iterative process. Actually, if you give him a different guess value, it will give you different solutions. But it will not tell you have 5 solutions. This is something that you have to figure it out yourself. This is something that you have to think yourself. Sometimes it's quite easy to figure out which solution is the correct one when there are multiple solutions. Like in this case. In this case, it's not so difficult to show that actually this has to be a positive net present value. But you know, sometimes you will have multiple positive solutions. You can have 10 different solutions if your sign is switching up and down. Which one to choose? And people often just put, okay, IRR of this. This might be completely wrong. I mean, Excel will just give you one out of these 10 solutions, which might be the wrong solution. So, I mean, this is how the net present value changes with the different internal rate of return if you plot it for this project. It will cross 0 at 2 points, at minus 44% and at 11.6%. You cannot say from this chart which one is the correct solution. And this is by far the most popular decision tools among the CFOs. Okay, another problem. There are cash flow streams that don't have internal rate of return. You cannot calculate them. Imagine the following cash flow stream. 1,000, 3,000, 2,500. I mean, this is a simple problem. So this is not a real issue of the method. Because according to this problem, I mean, if your boss asks you, should I take this, you tell him, of course you do, because you get something for nothing. Everybody likes that. So this is not a real problem, but it won't have internal rate of return, because no matter how much you discount these cash flow streams with whatever rate you use, this will never become negative. This will never become zero. Discounted cash flow stream like this will never be equal to zero. And it has a well-defined net present value, which is not 339, but doesn't matter. It's obviously not 339. So this is a mistake in the slide, this net present value. But it has a positive and clearly defined net present value. Okay. Another problem of internal rate of return. Mutually exclusive projects of different size. Imagine a real life problem. You have a piece of land over here. You want to build a building. You can build a building of 2 stories, or you can build a building of 10 stories. You cannot build 2 buildings of 2 stories. There is one piece of land, and you can put one building. It will have either 2 stories or 10 stories. Which one do you build? Well, let's imagine that this 2 stories building, you have to invest 10,000 and you will be able to sell it for 20,000. Or this 5 or 10 stories building, you invest 20,000 and you get 35,000. The first 2 stories building has an internal rate of return of 100%. The second one has 75%. Which one do you choose? According to this simple rule, choose the one with higher internal rate of return. You would end up choosing building D. But in reality, by building E, you earn more money today. You cannot build 2 times building D. If you could have built 2 times building D, everything would be okay. But you cannot. Now, this is not, again, big problem, because by thinking, you can solve it. You can say, okay, yeah, I earned 100% here, but I invest less, so I will earn less in total than here at the rate of 75%. So this is not a big problem, but there are some big problems. These multiple rates are pretty large problem. But there is one problem that there is no way you can solve, no matter how smart you are, which is that the internal rate of return can never take into account the fact that in real life, when you invest your money for 1 year, you get one annual rate, and if you invest your money for 10 years, you get another annual rate. It can never take into account yield curve. And actually, with the net present value, this is very simple. You just use different rates to discount different cash flow streams in different periods of time. It doesn't change complexity. You just don't use one R, you use R1, R2, R3, R4, R5. It doesn't matter. You can take this into account easily. With internal rate of return, this is not possible. And now you ask me again, but why do managers really love this internal rate of return? And my answer is, because it's in percents. And they like percents. And they don't understand the net present value that well. Just imagine if some random chief financial officer thinks, should I invest $100 million in a project that has a net present value of $1? His first intuition of every person is, come on, I invest 100 million and get $1. But the point is that the net present value doesn't not tell you that you get $1. You get $1 more than you would get if you invest this money into something else that is equally risky. It doesn't tell you how much money you get. It tells you how much money more you get than if you have invested into something equally risky. And you know, when you tell him, yeah, this thing has a return of 30%, he understands it. But whether he got this 30% right, and whether actually 30% is better than 15%, this is a tricky question. And we finally come to one of the least popular methods, which is Profitability Index. And I mean, this is less popular because this is not used for determining whether I invest in project A or project B. And there is a simple way how you can do it without profitability index, just by using net present value, and this is why some people use it, but this is a good method. This is not flawed method like others that I have mentioned. And profitability index is used when you want to select among the projects, but you cannot select all the projects that are available. Let's say you have multiple projects that offer you positive net present values, and you can select some of them because you have a budget constraint. Usually firms have constrained budgets. They don't have infinite amount of money at their disposal. So one way to do it is the following. Imagine that you have $300,000 to invest, not more than that, 300,000. And you have to choose between projects A, B, C, and D. All of them have positive net present value, and each of them has a different size of the investment. So you cannot invest in all of them. 300,000 is not enough for all of them. For 300,000, you can buy either each project A, project B, project C, project D, or you can buy also project B and project C, and project B and project D. They fit into 300,000. Now, profitability index is the ratio of net present value and investment. So you have profitability index of each of these projects. Now, what is weighted average profitability index? Now let's calculate weighted average profitability index of projects B and D together. So what is weighted average profitability index of if you buy together B and D? Well, the weighted average profitability index is the proportion of money of your total budget that you invest in project B times the profitability index of project B. So this 125 over 300. 125 is how much do you need to invest into project B divided by 300. This is your budget constraint. This is the amount of money that you have. So this is the percentage of your total money that you invest in project B. This is why it's called weighted average. It's not just average number. It will not be average profit. It will not be 1.13 plus 1.08 divided by 2. You have to weight them with the proportion of the money that you invest in each of them. So in project B, you invest 125 over 300% of the total 300,000 that you have times the profitability index of project B. Plus project D, you invest 150,000. This is basically 1/2 of your total budget. So 1/2 times 1.08, which is profitability index of project D. Now you are left with 25,000. So in project A, you have invested 125. In project B, you have invested 150. This is 275 in total. But your budget is 300. So you still have 25,000 to invest. Now you cannot invest in any other project. They are more expensive. So you invest these 25 into bonds, for example, or into stocks. Now what is the profitability index of anything that you invest into market? Profitability index is net present value divided by the investment. What's the net present value of investing in a bond? It's 0. Because you pay the market price, which is equal to the present value of the cash flow stream that it offers. So it's 0. So profitability index of investing in market is 0. And you add these numbers together and you get weighted average profitability index of investment that goes into project B and project D. Now you repeat the same thing for all other reasonable combinations, which is B and D we calculated, project A alone, or B and C together. Everything else doesn't make sense. Either does not fit in a budget, or it's obviously smaller, or it offers you obviously less. And you choose the combination that gives you highest weighted average profitability index. Okay? Alternative to this would be that you calculate the net present value of all these projects of all the combinations of these projects, and you choose the combination with the highest total net present value. This is also an option. This is maybe mechanically easier. It's easier to write a program to do that than to find minimum, maximum, and stuff like that. You just order stuff and that's it. Okay. Now a little bit of a blah blah thing in the class. So, when you are valuing something, when you're using a net present value to make a decision, you have to take care that the only important thing is actually a cash flow that takes place, not some imaginary things, but the cash flow stream. As you have seen during the classes, I give you some text describing you buy machine, you do this, you do that. But at the end, we just draw one diagram which is a kind of a cash flow stream representation of the story. And this is what matters for using the net present value rule. Now, this cash flow stream should be the real money that you get, not some before tax or whatever. I hear many people saying things like, yeah, it's really good to buy, I don't know, Apple products in the US because they are so much cheaper. When you go to the US Apple store, it's much cheaper to buy iPhone, iPod, whatever in the US. They have much lower price. But the point is, in Europe, all the prices that are quoted on the Apple store are tax included. In the US, you still have to pay tax on that. This is not the price that you pay, the one that you see on the website. And then this tax will be different in New York, and it will be different in San Francisco, because New York City tax is different than San Francisco state tax, or whatever. I don't know. I'm not a tax person. But the point is, cash flow stream is important. And not any cash flow stream. What is important is incremental cash flow stream. So what do I mean by incremental cash flow stream? Imagine that you are a Sony corporation, and you want to start selling Sony PlayStation number 4. When you want to calculate, should I do this or should I not do this? This should not depend only on the cash flow stream that this project will offer, but how does this changes the total cash flow stream of the whole corporation, because Sony PlayStation 4 will cannibalize the sales of Sony PlayStation 3 and the games that are being sold for Sony PlayStation 3. So the fact that matters is actually incremental change in your cash flow, not just something observed separately. Like with the bakers, you own 5 bakers, you want to buy a 6th one. You should not calculate what this bakery offers you if it works alone. I mean, this bakery might eat up part of your consumers in other 5 bakeries, because now some people can buy your products also in this one. So you have to take incremental cash flows. And this is not an average between these two. Incremental is incremental. Now you should be careful that there are some very hidden incidental effects that one should take care when these incremental things are calculated. Like, for example, government wants to build a bridge in order to I don't know, to kill the traffic jams in one highway, to remove traffic jams from one highway. And you build a bridge. But you have to take into account that this might create traffic jams on another highway. And these things are usually very, very difficult to estimate, because everything is connected with everything. Especially if you're a large corporation. Some corporations don't even know what some of their divisions do. And the fact that, for example, Sony PlayStation 4, or I don't know, Sony PlayStation 4 might have, I don't know, some new fancy connector for a TV. Then that might mean that some people will want to buy different TVs and will stop buying TVs that don't have this kind of connector. I don't know, I'm now inventing cases. But all these effects should be taken into account. It's a complicated economic system, especially when the large corporations are in question. Now I will skip some of these and you read this blah blah in the book, but I will talk about sunk costs. Sunk costs are common mistake that many people in their everyday life are doing, and especially governments are doing, and selling these stories to their taxpayers. So at some point, European Union decided that they want to build their own fighting jet fighter, Eurojet. They have burned billions and billions of taxpayers' money in order to build fighter jet. And this was kind of meant to be a competition to US fighter jets and Russian fighter jets. And then when they realized after 5 years of doing this, they said, man, this is much more expensive than we expected. We need to burn many more billions in order to finish this thing. And they said, and they tried to argue this in front of their taxpayers by saying things like, we have burned billions so far. It would be wasted money, so we need to burn billions more to finish this project. This is simply a fallacy. The fact that you are going to decide on future investments should matter only, is this worth doing or not? The fact that you have burned billions so far doesn't matter. And many people do these kind of mistakes, especially when they are building their houses or like rebuilding their apartments or housing. I mean, this is a common mistake because people are not able to estimate these costs well. So everybody will this is like a common mistake. Everybody underestimates the cost of a building of a house, usually by factor 2 at least. Everybody underestimates the cost of rebuilding a flat, usually by a lot. And then they will start rebuilding, waste millions or thousands or hundreds of thousands, and then after 2 years they will say, man, I need a lot more money to finish this. Should I do this or not? And they will think, well, I have burned so much money so far, so I should finish it. This is simply wrong. You should finish it only if this investment is worth what you get at the end. Otherwise, don't finish it. It's as simple as that. Sell it. Also, you should be aware of what is called overhead costs. Overhead costs is something pretty simple, but people often forget about it. Imagine that we are now in one company and we are deciding whether to invest in one project or not. And is this project profitable or not? Well, we have to also think about the fact that somebody is paying for this electricity. This is also a cost. The fact that we are sitting here and thinking about this project means that somebody has to pay at least part of these expenses. And usually there are standard ways how to deal with it. You cover some, like 10% or whatever, you somehow distributed it among all the users of these common things. Also, you should treat inflation consistently. What does it mean? We learned what is the inflation. And how do you treat it consistently? Discount nominal cash flow streams with nominal rates. Discount real cash flow streams with real rates. So, to give you an example, imagine you have a following cash flow stream, like in nominal terms, in dollars, $8,000, $8,240, etc. And let's say that something equivalently risky is offering you 10% per year in nominal terms, non-adjusted to inflation. Then you just discount these nominal figures, nominal cash flows with nominal rates, and you get the total present value. Now, alternatively, if you don't have nominal rates, but you have, let's say, real cash flows. You don't have nominal cash flows, but real cash flow. So what are real cash flows? These numbers are not in terms of money dollars. This is in terms of how much stuff you can buy. So if price of apple was $1 per apple, that means that in year 1 you will be able to buy, I don't know, 7,766 apples or whatever. So this is in real terms. This tells you how much stuff you can buy. So this cash flow stream in real terms is this, if the inflation is 3%. If the inflation is 3%, this is how much stuff you can buy each year. Now, if somebody gives you these numbers, 7,766 every year in real terms, then in order to calculate the present value, you cannot discount it with the nominal rate. You have to use the real rate. How do you get to the real rate? 1 plus real interest rate is 1 plus nominal divided by 1 plus inflation. So the real interest rate is 1 plus nominal over 1 plus inflation minus 1. 1.1 divided by 1.03 minus 1 is 6.796%. Now if you discount these real numbers with real interest rate, you will get to exactly the same number of 26,429.99. And it makes sense, because this is in dollars today. Inflation should not matter. Why should inflation matter? So if I ask you, I have $26,429.99 today. If the inflation in 10 years from now is 100%, how much do I have today? I mean, it doesn't matter. The inflation doesn't matter. I mean, these are dollars today. These are not dollars in 10 years from now. So this is why these two numbers are the same, 26,429.99. If you treat things consistently, nominal discounted with nominal rates, real cash flow with real rates, you will get to the exactly same conclusion. Okay, now I want to cover something that I think is quite... So, in every book, not only in this book, this is covered in a weird way. I have tried to find a book in which equivalent annual costs are treated well, and I don't believe that there are, in any book that I have seen, they are not treated well. So I will now try to explain to you how to do it properly. In the book, they will tell you this is the formula, net present value divided by some annuity factor, whatever. But now I will try to explain to you how, using your brain, actually you can solve problems when these equivalent annual costs are used. It's different than in a book. So imagine you have two problems. You have this problem. You are a factory. And in order to do whatever your business is, you need to buy a machine. And you can choose between two machines. And this is a very common problem. You can buy machine A, which is more expensive. You pay for it 15. To be formally correct with the notation that we have used so far, this should be minus 50 because you pay for it, but doesn't matter. So you pay for it 15, and then in year 1, maintenance costs are 5. In year 2, maintenance costs are 5. In year 3, maintenance costs are 5. So this is how much you pay. Now, machine B is less expensive. It costs more to maintain, and it lives less. It breaks after 2 years, not after 3 years. After 2 years, you need to replace it. So you can think about it. This is some German expensive machine, and this is some cheap Chinese machine. And you know, cheap is not bad by itself. Cheap is good. Yeah, it will last shorter, but it's cheap. And you know, sometimes this might be an advantage. Like when buying a furniture. This is why IKEA is winning the furniture market and not expensive German furniture producers. You can buy some very expensive, robust, full wood heavy furniture, but then in 2 years your apartment will look like your grandma's apartment. And you will be able to buy IKEA every year because it's cheap and it will always look modern and nice because they always change their design. So sometimes it's not bad to buy cheap things. It depends from problem to problem. So cheap Chinese stuff is not always worse than good German stuff. Sometimes it is, sometimes it's not. And we need to be able to decide, should I buy machine A or should I buy machine B? Now, net present value application, if we calculate the net present value of the machine A or machine B, we will get this machine costs us 28.37. This machine costs us 21, but this is in today's money. Which one should you buy? This is not clear. One could say, well, we will buy this one because it's cheaper. Yeah, it's cheaper, but it lasts less. You need another one after 2 years. So how do you deal with these problems? One way could be, okay, let's think about how much this costs me per year. What is the cost per year? Now, how do you transform this into annual thing? One naive thinking would be, let's divide these numbers by 4. This number by 4 and this number by 3, and we will get annual costs. But this would be like saying $28 today is the same as 4 times $7, $7 each year. This is not true. We know time value of money. This is wrong. 7 plus 7 plus 7 plus 7 is 28, but not $7 today plus $7 in a year from now plus $7, etc. So, let's think about the following, and let's use our brains. This is the cash flow for the first machine. And we know that the present value of the first machine is 28.37, which means that we are indifferent between this cash flow stream and this cash flow stream. If I give you this cash flow stream, is the same as I give you this one. You are indifferent because they have exactly the same present value. So $28.37 today is the same as this cash flow stream. So what's the idea? The idea is that we want to find the following cash flow stream. We want to find the cash flow stream that will be same amount of money every year, but starting in year 0, because this is when we start. And this is where the confusion with the book starts. They assume, okay, let's pretend that the first cash flow stream starts in a year from now. But when you buy a machine, you buy it today. You don't buy it in a year from now. If you buy it in a year from now, this derivation would be slightly different. So what is the idea? We want to find the cash flow stream that pays constant amount over these 4 years, basically starts today and for next 3 years, that has the same present value as this one, 28.37. So how do we do that? We need to find this C. So this is the cash flow stream that we are starting from, 28.37 today. This is the present value of machine A. And we want to find the cash flow stream that will pay annually some amount and have the same present value over the lifetime of this machine. So how much this machine costs us per year. So note that we can represent this cash flow stream as this cash flow stream plus this cash flow stream. This is like obvious. Now, the first of these two is just a normal annuity. Annuity is, we said, is a cash flow stream that starts in a year from now and pays constant amount of money for some period of time. And then the last thing is just C today. So the present value of annuity is given by the annuity formula. Present value of this is just C, and we want these two present values together be equal to the 28.37, and we need to find this C. Well, solve this equation for C. If you solve this equation for C, you plug in the numbers and you get 7.72. I mean, you know, these are like big equations, but this is something really simple. I mean, this is 1 over r minus 1 over r times 1 plus r to the power of 3. I mean, this is just plugging in numbers, you get to 7.72. It's not that complicated. So what is this 7.72? Well, imagine the following. You have the $28.37 today. Now what I claim is that this is the present value. Now what I claim is that if you have $7.72 every year starting today, this will have the present value of 28.37. Well, you can verify this, and you get to the same number. And that's it. This is how you should deal with these projects, that comparing projects with different kind of lifetimes, but you expect that you will have to do them again. So this is a machine, and you will need another machine after 2 years or after 3 years, depending on the machine that you buy. So which one do you buy? You buy the one which costs you less per year. Which one costs you less per year? Well, I don't know. I haven't calculated the same thing for the Chinese machine. You do it. Just repeat the same same mechanics, but your annuity will not be for 3 years, it will be just a 2-year annuity. The present value will not be 28.37, it will be less, and then compare them. Any question?
Couldn't I just, I have one with a time horizon of 4 years and one with 3 years. Couldn't I just calculate that for 12 years so that I...
You could, but imagine that one machine lives 7 years and one lives 11 years. Then you would have to do the estimation for 77 years. And this is a long time. You don't even know whether, your machines, whether this business will exist after 77 years. This will have this kind of an assumption hidden in it. So you could, but this is a better thing to do because you look less into the future. And we don't know much about the future. Any questions, comments, short speeches? Okay, I would really appreciate if rest of you who haven't filled in the survey to do it so I could get a better picture of what's going on in the class and stuff like that.